Good morning, friends. My name is Anup Nigam. I'm a technical analyst. In the previous video, we learned about how do we calculate the profit or loss for the short call option. Now, in this video, we'll try to understand how do we calculate the profit or loss for the synthetic long call option. Synthetic long call strategy is a combination of a stock and a put. We normally purchase a stock when we feel bullish about it. But at the same time, we always remain concerned what if the price of the stock goes down. So in order to ensure our position, we buy a put option of the stock. In this strategy, we buy either the ATM or OTM strike price put option. So if the price rises, we get the full benefit of the price rise. But if the price falls, we cap our losses with the put option. It's a strategy with limited losses. Now, when to use this strategy? This strategy is to be used only when we want to own the stock for short term to medium term. But at the same time, we are concerned about short term downside risk. Risk can be calculated by adding stock price and the put premium and then subtracting put strike price from that. In this strategy, the profit potential is unlimited. Break even can be calculated by adding the stock price and the put premium. Now, let us try to understand this with the help of this table. Now, if the spot price of a stock X trades at 4,000 rupees and we buy the put option of strike price 3,900 at a premium of 143.80, then the break even in this particular situation would be stock price plus put premium. So that means it would be 4,143.80. Now consider an example. If we buy 100 shares of stock X, which is trading at 4,000 rupees per share, and we buy the put option of stock X of strike price 3,900 at a premium of 143.80 per put. And this stock X has a lot size of 100. So the net debit would be stock bought plus premium paid. That means 4,14,380 would be deducted from our account. The maximum loss from this strategy would be stock price plus put premium minus put strike price. So that means the total loss could be 24,380, whereas the maximum gain can be unlimited. Break even can be calculated by adding stock price plus put premium. So that means in this example, the break even would be 4,143.80. Now let us try to understand how do we calculate the payoff for the synthetic long call option. As we know that we have bought stock X at a price of 4,000 rupees and we have bought put option of strike price 3,900 at a premium of 143.80. So if on expiry the spot price of stock X closes at 3,400, we will have 600 loss from the stock. We will have 356.20 profit from the put option, and the total loss would be 243.80. If it closes at 3,600, we will have 400 loss from the stock, 156.20 profit from the put option, and the total loss would be 243.80. If it closes at 3,800, the loss from the stock would be 200, the loss from the put option would be 43.80, and the total loss would be 243.80. If it closes at 4,000, so there'll be no profit, no loss from the stock, whereas there'll be loss of 143.80 from the put option, and the total loss would be 143.80. If it closes at 4,143.80, then which is the break even point, then the profit from the stock would be 143.80, whereas the loss from the put option would be 143.80, and in totality we would have no profit, no loss. If it closes at 4,200, the profit from the stock would be 200, the loss from this put option would be 143.80, and the total profit would be 56.20. If it closes at 4,400, the profit from the stock would be 400, the loss from the put option would be 143.80, and the total profit would be 256.20. If it closes at 4,600, the profit from the stock would be 600, the loss from the put option would be 143.80, and the total profit would be 456.20. And if it closes at 4,800, the profit from the stock would be 800. The loss from the put option would be 143.80, and the total profit would be 656.20. So from this table, we can evaluate that we have minimized our losses, we have capped our losses, whereas the profit potential is unlimited. Now let us try to understand this with the help of the graph. So if we buy a stock and it keeps on moving upside, then we'll have a good profit potential. But if in case it falls down, we ensure our position with the help of this put. So, when we buy a stock and we buy a put, it becomes a synthetic long call option. So, in this particular strategy, as you can see from the graph, this is the capping. I mean, the loss has been barriered, whereas if the stock rises, uh, we'll have a good reward and we'll have a good profit potential. So, guys, in this video, we have tried to understand that how do we calculate the profit or loss for the synthetic long call option. So, if you think that this video is informative, then please like this video, subscribe my channel, and share this video with as many people as you can. Thank you. Dhanyavad.